Hey folks, Jeff Bangerter here with Bangerter Financial Services. Want to talk to you a little bit about kind of the details around the 1031 exchange using the Delaware Statutory Trust. And certainly me and my team are available for any questions. You're certainly welcome to give us a call. You see the phone number there, 916-965-1879. So the first question you have to ask yourself is, why not just pay the tax, right? Why do a 1031 exchange at all? And so the first tax that most people forget about is the depreciation recapture. You can see right there, it's 25% of whatever you've depreciated so far. And, let's say you've had a $1 million property and you've owned that thing for 25, 30 years or longer, and you've depreciated, let's just say $100,000 just for easy math, then you would owe $25,000 back. If it's a bigger number, if you've written off $1 million, right, in tax over the years, you're going to owe $250,000. And then you've got the federal capital gains tax rate. Unlikely any of you will be in the 0%. Most people think it's just 15%, but actually it can be as high as 20%. So you have to bear in mind, you have to kind of look at the current tax law to see where you're at, but it's very likely you could be paying 20% in federal capital gains tax. And then you have the state tax rate. Here in California, where I'm at, it's just the current income tax rate, which is 9.3 to 13.3 sliding scale. And again, very easy to get up into that 13.3%. And then you have the net investment taxes, the federal tax. This is also known as the Obamacare tax. So this was a tax on net investment income of an additional 3.8%. So it can be significant. Here in California, you could be paying 38% of your gain. So if you have a $1 million gain, $380,000. And honestly, depending on your situation, could even be worse than that. And so the reason people do the 1031 exchange is they don't want to give 30 or 40% to, the governments, state and federal. So what are some of the rules just to keep you on top? The first rule is you must exchange for like-kind property. Well, what is like-kind property? We hear this all the time. Well, like-kind doesn't mean the exact kind. In other words, if you have a single-family residence, it doesn't mean you have to do another single-family residence. Or as this has farm for a farm, you can go from a farm to an apartment. You can go from a single-family home to an Amazon fulfillment center. You can, as long as it's property that's held for investment or gain, right? So you can exchange any business or investment real estate for any other piece of commercial real estate. The Delaware Statutory Trust, or DST, you'll hear us abbreviate a lot, are considered like kind per IRS Revenue Ruling 2004-86. So this absolutely qualifies for these really high-end commercial buildings, investment-grade real estate that will qualify for the 1031 exchange rule. Now, rule number 2 is you must invest all the proceeds to get the maximum deferral. I always like to caution people, you don't have to 1031 all the money. It's just whatever money you don't, you're going to pay tax on, right? So to get the full tax deferral from the 1031 exchange, you have to take on equal or greater property value as to what you've sold. Additionally, the debt must be placed or assumed on the property must be of equal or greater value as well. So if you had $100,000 of debt, you have to have $100,000 replaced. And then any net proceeds that you don't reinvest are subject to taxes, and that includes any debt that you don't replace. So if you had $500,000 of debt on $1 million property and you buy $1 million property that only has $400,000 of debt, you either pay tax on the remaining $100,000 or you have to put in $100,000 of cash. It's your choice, or pay the tax. That's always a choice, right? So the DST is a great tool because the minimums are typically $100,000, making it great for any wanted cash or debt boot. So if you were doing a 1031 exchange from an apartment to an apartment or whatever, right, and you ended up buying something that was $100,000 less value, we can make up that $100,000 for you, very simply. Rule 3, you must adhere to the 1031 exchange timelines. So you have to, from the day that you close escrow on your relinquished property, you have 45 days to identify the replacement property and 180 days total to close on those properties. Well, what's nice with the Delaware Statutory Trust is we have property always. There's always some Delaware Statutory Trust properties available for you. We can identify them in as little as a few minutes on the phone. I mean, it's seriously that easy. And then we can close within a couple of days. And then Rule 4, you can't touch your proceeds, your sales proceeds. It does have to go to an exchange company. So that's a key, and we like to work with all the good, high-quality exchange companies. Give us a shout. We can give you a list of some really good ones. So the intermediary must hold those proceeds and then pass them along to the replacement property to purchase it for you. You need to engage an intermediary before you close for sure. What I recommend is as soon as you get an offer, you should be talking to a qualified intermediary. The Delaware Statutory Trust, again, many of the leading qualified intermediary companies are working with us. They know what DSTs are. Rule number 5, the same legal entity must sell the relinquished property and buy the replacement property. So the entity on paper that is selling the property must be the same on the new property. So if you have a joint tenants with right of survivor with your spouse, that's how you have to buy the new property. If it's in your revocable living trust, that's how it has to be. For multi-owner entities, it can get a little tricky. If you're in a partnership and the partnership owns the property, then the partnership is the entity doing the 1031 exchange. Now, if you own the property, again, as joint tenants or is in tenants in common, then you can go your separate way when you sell the property. The Delaware Statutory Trust, again, is not an LLC. The DST investors own an individual beneficial interest in the underlying real estate asset, and so you can do the 1031 exchange upon the sale of the real estate. And again, the DST, Delaware Statutory Trust, is a securitized real estate product. So the DST entity structure allows the smaller investor to own a fractional interest. And I want to help you understand this, right? So you're getting a fractional interest in a very large institutional quality and professionally managed commercial property along with other investors. And you're not limited partners, but you have individual owners within a trust. And each owner receives their percentage share of the cash flow, income, tax benefits. All of the tax benefits flow through to you. So, and then you think about the potential asset appreciation, right? You are an owner. This is not some other entity that owns it. You own it together with these other investors, right? So you collectively own it. You get all of the appreciation of the asset as well. Fractional ownership, just again, most large estates do this. Family trusts, endowments, pension funds, life insurance companies do this, and high net worth individuals participate in fractional ownership. The Delaware Statutory Trust makes fractional ownership available really to everyday investors. Now, quite frankly, you do have to be an accredited investor, which is $1 million net worth or income in excess of $200,000 as an individual or $300,000 as a couple. So by definition, you essentially are a high net worth individual. And then the low minimums, you can get in for as low as $100,000. It really does allow for better diversification of your 1031 proceeds. And then again, the IRS approved the 1031 exchange replacement property, allowing you more options for your exchange, right? So these DSTs have been, they are in the IRS code, which is nice. They're pre-packaged investments, which does save you time. You can sit down with us, and in an hour we can show you 8 or 10 different offerings and go through the due diligence material available through the private placement memorandum, the PPM. And as we show you these things, it'll be clear what your situation is within there. There's non-recourse debt already in place. When there is debt on a property, right, it is non-recourse. You don't have to do a property that has debt, but we want you to know if there is debt, it is all non-recourse. You have no responsibility for it. Nobody can come after you for it. It's really the best way. By the way, it doesn't show up on your balance sheet either. So if you needed to go get a bank loan for other things, you could without having to worry about the debt on this real estate. It is institutional quality, so it gives you these really large portfolios. Again, brand names that you all know, beautiful apartments, 60 or $80 million apartment complexes, storage facilities, all kinds of things, in senior housing and medical offices. And the beauty of it is all of the management responsibilities are lifted away from you. They're all handled by the sponsor company. So management free. The DST is a sole decision-making authority on the investor's behalf. It's responsible for all the property management, asset management, and property operations. We are never going to call you up and say that something needs to be repaired, that you need to add any more money to it. I mean, this is very, very hands-off. You leave it alone, we take care of everything. There's no receipt or record keeping that you have to do. We provide all of that to you at the end of the year in a very simple tax form that you give to your tax preparer, and you again get all of the tax benefits of ownership. This really allows you to give up all of the toilets, tenants, and trash responsibilities. Again, we're not going to call you up ever and tell you what's going on and we need some kind of help in fixing or repairing something, right? No capital calls or out-of-pocket expenses. There are literally no bills, no unforeseen expenses. I've had people over the years tell me, oh yeah, I'm making all this great cash flow until I had to put that $80,000 back in to repair the building. Well, gee, how many years of your income did that delete, right? So this is very straightforward. So I think it makes sense for most people. Let me give you a few scenarios here. You decide if it sounds like you, if it resonates with you. Scenario one is, my rental properties are a headache. I never want to get another call about a clogged drain or find a new tenant ever again. But if I sell, I have a significant tax bill, plus I need the income. So the potential solution is a 1031 exchange into the Delaware Statutory Trust property, which can defer the taxes and transfer all management responsibilities to the industry-leading real estate sponsor companies. These are multi-billion-dollar companies that are managing these assets for you. Scenario two, my rental property is fully depreciated and no longer generating tax advantages. I'd love to sell my property and 1031 exchange into a newer one, but I'm panicked about the 45-day timeline. What if I can't find something suitable to buy within the 45 days? Potential solution is identify a DST as a backup property on your IRS identification form before the 45th day. A reservation in a DST will be made in your name, and you can close on the property as soon as you're done. Or if your other primary product falls through, we're there, we're available. We will not fall through for you. Scenario three, I feel like now is a great time to sell my rentals to capitalize on the high values. I like the idea of exchanging into a new market with more potential for appreciation. As I mentioned, I'm here in California. Real estate in the West is really pretty maxed out, and the governments, certainly here in California, have kind of, lost their mind, let's be honest. And so they're doing everything possible to discourage people from owning investment property. And so we have a lot of people that are, taking their cue from the government, and they are selling their investment property. And you can do the same, and you can move that money into a DST property located somewhere else, a nice friendly state like Florida or Texas or Nevada or Tennessee, right? And these are business friendly states with no state income taxes. There's really some great opportunities. Scenario four, I'm currently in a 1031 exchange. My rental sold for $500,000. The replacement property I like to purchase is only $350,000. Unfortunately, I can't locate anything else for the $150,000 I have left. So you could end up paying some tax on that boot. Well, the potential solution, a 1031 exchange for the $350,000 that you're doing, and then we can be the backup on the other $150,000. Because remember, our minimum size is $100,000, and so we're going to be able to take care of that for you. Scenario five, I know I'm not charging market rents at my properties, but I don't really want to deal with tenant turnover, the vacancies, or the gaps in rental income, so I just leave my tenants alone. Well, you can 1031 exchange into a DST property with anywhere from a single national tenant to a 1,200 unit or more apartment. And multi-unit DST programs offer vast diversity of tenancy for smoother income fluctuations. And the managing sponsor will use the apartment pricing models to maximize rents and minimize vacancies. This is all high-tech computer-based pricing. We are maxing out the rent on every property. We're not letting people skate for years and years at the same rent. Scenario 6, I need or want to replace debt in my exchange, but I don't qualify for a mortgage because I just retired or changed jobs or gone through a divorce or whatever, right? So I don't want to have to worry about replacing that debt. I don't want to pay tax on it either. Well, you do a 1031 into a DST that is leveraged at the ratio that you need, and we just assign you the debt. Again, no personal guarantee, no personal responsibility or anything. And we just assign the debt to you. You don't have to worry about it. So we like that as a solution. Scenario 7, I'm concerned about estate planning. I'm not convinced my spouse or heirs will know how or will want to manage these assets once I pass. That's very common, I got to tell you. I have a client, been a client for a long time with me, and he told me that he thinks he has cancer now, and his wife doesn't know how to deal with this stuff, and his kids don't want to. So, we have a solution. We can do a 1031 exchange into a DST, simplify the real estate ownership. When you do pass away, the interest can be bequeathed to different entities in different amounts per your instructions. So your inheritors will still get the stepped up basis when you pass away, but they don't have any management responsibilities or headaches. And honestly, maybe you have one or two good kids, but that one kid's living in one of the places rent-free. This is nice too, because you can sell it and your kids will still love each other after everything's divvied up because we're going to do it for you. Anyway, the liquid structure and potential monthly income will give your heirs time to make long-term decisions. I like this best because honestly, you think about it, if your kids haven't produced millions of dollars of savings themselves and you all of a sudden drop a few $1 million into their hands, generally that doesn't go well. First off, it breaks families apart. It's an awful thing to see. I've been doing this for 40 years. I've seen it over and over again. Everybody's great until it comes to money. So if you can separate this before your death so that you don't have to worry about it, your family will still love each other for generations to come. But if you leave it there for them to fight over, you're going to destroy the relationships between your kids. Scenario 8, I have a large amount of cash in my bank account, paying me 1% to 2%, and I really want to get some more income. Well, not every client or every advisor that we work with does this, right? We do. So you could put that money to work in real estate. It's highly tax advantaged. So hopefully that's helpful. If you have any questions, again, our phone number right there, 916-965-1879. You can go to our website at bangerterfinancial.com for more information. Thanks for listening. I hope you found this helpful, and give us a call if you have any questions. Thanks again.